Okay, I'm having a little bit of video issues right now, so I may have to. I don't know. Anyways, so we were here. We need to find beta of a stock of Apple, and what is beta, right? Beta is basically how correlated um, a stock is with the overall market of stocks, right? So you want to know kind of, for example, you can see here with Apple, they have a beta of 1.16. So what does that mean? Well, a beta of 1 means that basically a stock is equally as volatile as the market and moves pretty much the same as the market. If the market goes up 1%, the stock goes up 1%. And adversely, with Apple, they have a beta that's higher. So technically, it's kind of saying that um, if if the market goes up 1%, the 5 year trailing monthly data says that Apple's going to go up 1.16%. Is kind of all that's saying. So we'll put the beta in, and we'll get 1.16, and from there we have to find the risk-free rate, right? And what is the risk-free rate? Well, the risk-free rate is found through that link that I just clicked on, and it's going to be right here. And you're going to be brought to this website, and you're just going to want to hover over, the USA, right? And you're going to see that we get a 4.232%, and that's going to be our risk-free rate. Our risk-free rate is basically like the true time value of money that investors want outside of any risks of default, right? We assume that the U.S. government is not going to default on its debt, and that any investment that you make in the U.S. government, you are only getting basically a return on your money that you want, right? So investors are seeking a 4% return. It goes into a little bit more depth when you look at like how interest rates are and interest rate yields on bonds are set. But for now, I mean, this is the risk-free rate yield. And adversely, so that kind of builds into the market risk premium also. So the market risk premium is the expected return of the market minus the risk-free rate. And that is because if you think about it, if you're getting 4% risk-free with zero risk of losing that yield, right? What yield on top of that do you need to invest in some risk, right? And that's where the market risk premium comes in. Is basically like the broad return that you would look for as an investor that you want to invest in basically equities and take on some risk of more volatile returns. So you would add to kind of find like the expected return of the market backwards. You would just add these two together, and you would see that the expected market return is like 9.7%. But anyways, moving into the cost of equity, we calculate cost of equity using CAPM. And CAPM is literally just y equals mx plus b. But instead of y equals mx plus b, it's risk-free rate plus, which is our intercept, times our beta times market risk premium, and we get a cost of equity of 10.61%. So something that I will say for this is that when we calculate WACC, we use after-tax cost of debt. So something I want to do really quick, and you can do this as well, is I just want to take the pre-tax cost of debt and multiply it by 1 minus the tax rate to find our after-tax cost of debt, which is 3.9%. So from there, only thing we're doing is if you think of what WACC is weighted average cost of capital. So all we're doing is basically weighting the returns of this company, what they pay for debt, and also weighting the return of what they pay on equity, which is their cost of equity. So we would just do basically, obviously a weighting problem. So it would just be 10 times our cost of equity times the weight of equity plus the weight of debt times the after-tax cost of debt. And we would get that, and that's going to give us our WACC. And so from there, we're able to go and actually find the present value of these free cash flows because, in the formula CF over 1 plus R, what is R? Well, R is our WACC. So we have to have WACC, obviously, before we get into, discounting for cash flows. So, the cash flow the present value of cash flow's formula is PV equals CF over 1 plus R to the times power. So our CF obviously is going to be this. So we're just going to take our free cash flow and divide that by 1 plus our WACC. And then we're just going to raise that. And when we do a raise, when we use an exponent in Excel, we just press Shift 6, and that's going to be give you that little arrow. And then we're just going to raise that to the date, the year here, which is why we use 1, 2, 3, 4 instead of 2026, 2027. Make sure that you lock your WACC, and from there you can just autofill over. So that brings us over to terminal value. So how do we find terminal value? Well, we find terminal value by the first thing we have to do is really we want to find our year 6 free cash flow. And you can either forecast that out by adding on to, obviously, all of this and just building everything else out to a 6-year. I honestly forgot to do that. So we're just going to basically take our year 5 free cash flow and multiply that by 1 plus our revenue growth rate. It's not always exact, but you know what? It's good enough, right? I'm feeling kind of lazy. So that gives us our year 6 free cash flow. And what we want to do from there is we want to use something called the Gordon growth method. And the Gordon growth method is basically like a perpetuity formula to find basically the present value, what something's worth if it went on forever, right? Obviously, Apple's probably not going to go on forever, but we do kind of assume that when we build out these models. So what we're going to do is we're going to take our year 6 free cash flow and we're going to divide that by our WACC minus the growth rate. And that is going to give us basically the present value of all cash flows after year 6 dated back to year 6. And you're going to want to make sure that you use a terminal growth rate for this. Make sure you use a terminal growth rate. I've set it at 3%. Generally, you want to sit around 2 or 3%. And that's going to give us the terminal value is going to be a big number of all cash flows for the rest of time discounted back to year 6. But we have to discount it back to year 0. So on top of that, we need to basically do another present value formula. And it's literally just going to be, just like everything else we've done. Cash flow over 1 plus the R to the times power. This time we're going to use the 6th power, obviously, because it's year 6. And that's going to give us the present value of all of our cash flows, right? Of all of our cash flows forever. And then the next thing we have to do is we have to calculate, I think I made a mistake. Watch this. So yeah, I called it a mistake. So something I did is you don't want to use present value. You have to use your actual year 5 free cash flow. If you use your present value back to year 5, obviously there's problems. So make sure that you use your year 5 free cash flow, not the present value of your year 5 free cash flow. And that's going to give us a terminal value that looks more like it should. And so the next step is calculating our enterprise value. So what is our enterprise value? Well, our enterprise value is basically the sum of all of our future free cash flows and also our present value of our terminal value. So in a sum function, you see that I have 2 different variables here. You just break these up with a comma when you're using different areas. So because if you don't do that, then it's going to break. So you have to make sure you split these up with a comma, and that's going to give us our enterprise value. Now, we don't want enterprise value because we're equity investors. We don't really care about the debt of the company. We're not, buying the entire company, so we don't have to worry about the enterprise value. So what we're going to do is we're going to subtract net debt, which is debt minus cash. All right. And to do that, we're going to go over here to the financials of Apple. And we're just going to go to their balance sheet, and they will we have our total debt listed, but we don't have our cash. So to find our cash, we're going to go current assets, cash and cash equivalents, and then we're going to drop this down until we see just cash. And we see that as 27,199. So we're just going to put that in there, and we're also going to want to add our total debt, and that's then going to give us our equity value when we take our enterprise value, subtract debt, and add cash. And the last thing that we have to do is we have to divide it by shares outstanding. Now, where do you find shares outstanding? Well, you find shares outstanding in statistics in the statistics tab. And we're going to want to use implied shares outstanding. You don't want to use just regular shares outstanding because it does not, in the just regular shares outstanding does not include like convertible bonds that are in the money, options that are in the money. We want to include everything that is going to be dilutive to the stock price. So we're going to use this number. It's going to be 15.32 billion. So we're just going to make that 15,320,000. And then we're just going to divide this. So we're just going to divide it, and we come out with a share price of 224.73. And you can see that's pretty close to the actual stock price. You know, that doesn't mean anything per se. It doesn't mean that I did it right or wrong. It just means that you know, if I did make a mistake, it's probably pretty small. But you know, just because your valuation doesn't you know, directly reflect the exact stock price that you're calculating DCF on, it doesn't mean that you're wrong, right? It just means that you might want to scrutinize your work a little bit more and see what you did. So, but yeah, I'm looking forward to seeing what you guys do with this. And if you have any questions, feel free to email or text me. And I hope to see you guys soon.